Hey everyone, happy Wednesday. Welcome to another edition, #AskRobCo with James Wild. Hope you're well, James.
Yeah, very well. Thanks, Rob. How are you?
Yeah, really good, thank you. Welcome back everyone for another edition. As always, the market is moving so quickly. Every week we have got something to share with you or tell you in terms of what's happening on the ground, data, intel, market movements and activity that we're seeing. Thank you everyone for joining us always. So let's go straight into the data. Let's go straight into the handouts. Let's let you know what is happening pretty much live this week, week 11. So if you go to handout on the right hand side, sales intel 21st of March 2021, let's look at the headline numbers and see what we're seeing and what's being reported. So new instruction levels, you can see the last 4 weeks there, we're consistently at the 350 plus mark, which is very good activity, very good volume, very good numbers, not still at the levels that they were at the last quarter of 2021, but still good volume. So as long as the new instructions are coming through and the agents are telling us that more and more instructions and valuations are taking place, that feeds into the system, and ultimately the end result of that is more sales activity. So what we've seen consistently over the last month now is more and more instructions. Where did that come from? The change in the lockdown, the schools going back, more and more properties are coming on stream, and the agents are all telling us that that's the story that they're seeing. Then looking at the sold numbers, slightly down this week to 207, but everything has hovered 200 plus. It's very consistent, and the expectation is on the back of the last 3 weeks of good activity from the instructions, I would say probably a month from now, the end of April, you're going to see an uptick in the sold volumes as those new instructions filter through. So very consistent patterns here, very clear paths, and I think pretty much we're reporting a very consistent story. That's what the data and the evidence is telling us, very slowly but very surely, improvements and strengthening week on week in instructions and sales, and that will continue because of the budget, because of the market sentiment, and because of the volume of activity we are seeing. James, anything you want to add on top of that?
Yeah, thank you, Rob. So just analysing some of the data on the number of sold properties, transaction volumes, it's hovered around the 200 mark since the start of February, which is obviously very positive. If we look back on the graph which we brought you, the transactions from the July, August, September, October periods also hovered around the 200 mark, which does indicate that the activity in the market has remained fairly constant in terms of transaction volumes, whilst new instructions have fluctuated somewhat. Especially that we haven't seen the highs in new instructions since last year, but we're sort of eagerly anticipating the market reopening come April and May, and that's going to be the real telling period, giving those buyers more available stock which they can look at, and will inevitably boost some transaction volumes, I believe.
Yeah, I mean, let's be really clear. With the budget and the government pushing residential, predominantly real estate, although the commercial market is returning gradually as lockdown and opens out and people return, the residential space with your 95% mortgages, with your extended stamp duty windows, is just going to see a good run for the next 6 to 9 months to reflect that. And we are hearing from the banks that we work with that there's good volume, good flow, and that will continue predominantly for the rest of the year. And I think that's going to be positive, and that's the sentiment that we're seeing, and the activity that's out there. What else have we got, James?
Well, I was just going to bring you some data which the house price index released part of Land Registry. They have said, there's obviously a lag on this data, they have said that the house prices did dip in January earlier this year, January 2021, by 0.5%. I don't think this is a particular surprise to us. The market obviously shut down over the Christmas period for around about 2 weeks. And whilst there was a slight slowing and easing into the market in January, I don't think it's a particular shock to us. And we've obviously brought you data live for the months of February and March, which I think Rob, on the whole, has been encouraging.
Yeah, definitely. I think it is important to understand that Christmas and then going straight into lockdown 3, the first few weeks in January, and quite heavily, obviously impacted pricing, activity, and the movement of the market, because people weren't seeing properties, offers weren't being made, things that literally shut down for that period, that 3 or 4 weeks. So it's obvious that we saw a dip, and all we're seeing now is week on week increased confidence, renewed activity, and that's going to strengthen. So I'm very positive of at least good volumes and good activity coming both from the agents that we are speaking with daily, and also all the lenders we're working with, the volumes that they're churning through. Yes, we've got Easter coming up now, so Easter always has a little bit of a down in terms of the holidays, people not working, and so on. So that's always a 7 to 10 day period. But once the first week in April is over with and we've got through Easter, then you're going to see the market driving and positively moving forward.
Just to bring you some more statistics from the Land Registry House Price Index, in terms of annualized growth in the property market, annualized as at January for that period is still 7.5% growth, which is obviously built on the back of a very positive house price growth across the year of 2020. This is in terms of January, that's the steepest fall in house prices since the initial, or the month after the initial lockdown in April 2020, which just again is positive. It just indicates month on month how the market continued to perform, transactions continued to take place, a new stock did come to the market.
Excellent. What else have you got for us, James?
Well, we've got some graphs for you today in terms of the affordability gap from sort of wages to the house prices. And should we take a look at the first of these handouts, affordability?
Yeah, let's have a look at that. So the first handout you're looking at is the regional divergence. Is that correct, James?
Yeah, let's have a look at the regional divergence. And I think this is very interesting. It obviously splits the UK in terms of its main districts. We obviously got the London hub there in the dark blue line. We've got some of the sort of northern Yorkshire and Humber, West Midlands, South West and Scotland. And this this graph highlights the house price to earnings ratios for some UK regions. As expected, we've got London. There is a gap there, with London obviously being the highest at around 11.5 times, with the rest of the country averaging around the sort of 6 to 7 mark.
Yeah, I mean, historically, the trend, at least, you know, in the last 20 years plus that, you know, I've been in the industry, that you would always be looking at, I don't know, broadly the 5 or 6 mark, and that's really where most of the country has been. And then you've just got the surge in the last decade in London that saw prices from the crash in 08, 09 just go north at an extreme rate, which clearly demonstrates why you know, we're at now 10 times, 11 times plus in that earnings ratio, which is really a reflection of what's happened in this London market over the last decade relative to the rest of the country that's been broadly level or slightly growing, but very consistent. And I think that has a huge impact on market activity. I think if we move to the next slide, this is one of my favorites, and something that for all of the lenders on the call at the moment that I presented for previously, this is the one that I really enjoy going through. And why? Because it's a real understanding from a macro time perspective of where the industry has moved to and where it is at this precise moment in time. And this is really what we want to share with you today. So if we're looking at handout number 3, and we're literally looking at, you know, it shows the last 140 years of house pricing, and And if we're seeing today house pricing and affordability, where the index is at the moment, it's broadly at a record high that it reached back in the mid to late 2000s. And then you had the crash of 0809 that brought it back down, and then it very quickly came back. So through my career and my journey, I came in at the peak. So the 80s reached a peak, Myras, Margaret Thatcher. Then we had the infamous crash and the deep recession of the early 90s, where my journey began. And if you saw at that moment in time, and it's so pertinent for me, and loads of you have been in the industry over that period, you would have seen that the index and the ratio would have been at broadly 4, and that was a very low level. And a lot of investors would have come to me at that moment in time and said, you know, it's so affordable and pricing is such a low level in terms of the price earnings ratio. It makes sense to buy now, because when price earnings ratios are low, it tells you that it's the opportunity into the market. That's just a common sense to price and understanding how expensive property is. So at that moment in the early 90s, broadly speaking, we were around 4. That clearly demonstrated on a historical context that it was a moment to come into the market. Then we saw the huge surge from 2000, the early 90s to 06, 07. The market collapses, it comes in, goes back down to 7 in 08, 09, and then it comes back very quickly to take us all the way to Brexit, and then a little dip with stamp duty, and then the pandemic, and then we've got the uplift of what we saw in the back half of last year. This is where we are today. We're at approximately 8.5 in the earnings ratio. So to everyone listening, what is that telling us? We are at record highs. You know, there's no two ways about it. The data, the information is telling us as of today, we're reaching a record high in the house price earnings ratio. James, what is the question that comes from that?
Well, I was just going to bring some statistics also to back up some of our points here. So if we go back in time slightly, 1939, the owner occupation percentage of those living in houses which are owner occupied, 33%. This rose dramatically to the year 2000 to around 70%, and then it has begun to fall. 2019, 64%. This has obviously given a rise in those living in rental accommodation as just a direct knock-on effect. And it really is the soaring house prices that helps to explain this decline in owner occupation of houses, since the increases in deposit needed for a purchase has grown, coupled with low interest rates. It allows house prices to gradually increase. We've obviously seen some government policy coming out recently in terms of lowering the requirements for deposits for especially first-time buyers, given the 95% mortgages. I think that's a real positive, just opening up and allowing the opportunity of sort of government-backed finance to acquire property, get on the property ladder.
Thanks, James. So really what I want to be the point of today and the point of this data is, and all of you in credit, sanction, product, risk, if it's so clear and so obvious that now we're at the most expensive point virtually in history in terms of the house price earnings ratio, from a lending perspective, from an affordability perspective, are we now entering to a point where historically there would be a change, something would happen, or has the whole dynamic of the house price earnings ratio change because debt is so cheap, and it means that repayments are affordable because that debt is so cheap? That's the question I get asked by every lender, every bank when I discuss this. Yes, the historical context made sense, and which is why the house price earnings ratio has always been a key indicator of whether a market is frothy and hot or underpriced. And now the question is, has the whole dynamic changed? Because is it now all about affordability, in the sense that as long as people can repay their payments because debt is so cheap. The key indicator is affordability for repayments and maybe not house price to earnings ratio. What are your thoughts on that, James?
I think it's a key point, Rob. The availability, well, the punitive nature of not being able to raise a deposit in the past has obviously massively decreased the percentage of those living in owner-occupied accommodation. And I think like we said, there are some initiatives to try and release that and enable those that are able to afford to service a debt or a mortgage to have availability to acquire property. Just one question I was going to pose to you, Rob. Obviously, when we've seen this gap or sort of rising average house prices to the earnings ratio become so high, it's usually there's usually been a dip in the market or some sort of fall off or correction, we might call it. And as we're sort of reaching those frothy levels of 2007, 2008, what do you think is different to that period now?
Yeah, I think, that's the question that every lender that's listening to this and everyone in credit, at risk and policy wants to know the answer to. And I think it's a brilliant question that should all be on the forefront of our thinking, because ultimately history does tell us that there could be something around the corner when these levels are reached. Caveat, like I just said previously, we're at record levels of virtually zero levels of interest rates and the cheapest debt that you're ever going to find. So the question really is there going to be an event that changes, that brings this back down, or should the whole dynamic now be purely to affordability on repayment of terms, because that's the key requirement from the lender and the bank? Now, that's an open question to all of the lenders, and a lot of the people in the room today or who listen afterwards have got a tremendous amount of experience and knowledge on those areas. And I think it's a discussion point that's really important, because once you get to these points in time, either something's changing or the dynamic of risk policy is changing to take into account different considerations. So I think it's a completely open-ended question, James, but it's something that everyone in policy and risk and sanction and credit and pricing should be aware of, because I think it's so pertinent once you get to these very high levels like we are seeing now. And as I said before, this is one of my favorite areas, because this is the document and the chart that I have literally studied for the last 25 years plus, because I think it's such a key indicator.
Yeah, and just a further point there, I think the market is more sophisticated now than in previous times, and there has been some government intervention through some of the initiatives which we have mentioned. But just in brief, the fall in real interest rates over the last, say, 10, 15, 20 years has made the sort of long-term real assets more valuable, especially in those high growth areas which we've seen. And during this period, there hasn't greatly been an increase in supply, which has obviously further fueled the housing and property markets.
Yeah, I think you're right that the sophistication and the demand and supply challenge of the industry has changed the dynamic of the way that we would look at such information and data. And what I'd also like to say with that sophistication is the market isn't so vanilla and mainstream as it was historically. And now you've got so many different products that are in the marketplace that are competing from an investment perspective, from an end user perspective, from even a lender product perspective, whether you've got your mainstream lenders and your challengers and your bridges, all competing in different areas and different aspects, driving a market where, especially the investment market, whether that's your buy-to-lets, your HMO, or your commercial product. I think the nuance behind now the data and the intel and the trends is so individual and so unique. You've got to break down all of this intel, all of this data into the specialist areas, and then work like for how an HMO, a buy-to-let, a shopping centre, a hotel, a standard resi is performing, and then understand the pricing and the return on investment, and then understand the repayments and product pricing against that. So it's very specialist, very nuanced, and we're moving into an era now, 2021 and beyond, where it's data, intel, trends to a very high level of sophisticated point of view that's going to dictate and understand to a much deeper and a much greater extent actually where we are in those areas. Very specialist. Some areas are performing, some are not. It's not as generic now as it would have been historically. What else have you got for us to close out this week, James?
Well, I just wanted to just touch on some of those topics, on what might be some of the reactions to try and ease the house price to earnings ratio. Is the government going to massively increase the supply of housing, or are they going to look to sort of slow the growth in house pricing? Are they looking for the economy to flourish, for wages to increase, to try and soften that ratio? I think the answer is probably a combination of things, but is there anything you'd like to add to that, Rob?
Yeah, I mean, you know my views on this, and I've repeated this every week. I see the government as providing incentives and motivating buyers out there to push the market, and I see the market growing in the short term because that's what the government want. That's where they want to drive the economy, and I see that strengthening in the short term. And I kind of, I'm open to the analogy, or some lenders I'm speaking with who are concerned that maybe that's kicking the can down the road. And I would agree with that sentiment. And I believe to a degree that is what the incentives and the government are looking to do to get us out of what is a highly sensitive, highly challenging market economy brought upon by an extreme circumstance like we've seen with the pandemic. And this show is literally to the day 1 year since lockdown. And when we started nearly a year ago, and we were having these conversations, all the lenders that we're working with and been speaking to on hours on end every day, we're just hoping that we get out on the other side with some kind of market. Their concerns were that this market was crashing and crashing fast, and anything that didn't reflect a crash would be a positive. And I would say, if we're going to do a review and close out today on what that year looks like, I would say residentially speaking, strength to strength. The market has just gone to another level and is being driven by demand and a bit of lack of supply, and that's just gone from strength to strength, along with the incentives from the government. The commercial market has been really challenged in a lot of spaces. Obviously, high street, retail, entertainment, hospitality has been absolutely decimated. Good news is that's returning, and it's returning very soon. As May, June, and July kick in, we're going to see the return of those markets, and that's a positive remainder of 2021. So all in all, yes, the industry has faced incredible challenges, like on a very special circumstance over the last 12 years. Broadly speaking, for our sector and our business, I think all of us agree we're in as good a place as we could be, considering what we've been through. And let's see whether the economy and business and the market sentiment, which is so key in this industry, drives us for the rest of the year. Anything else to close out, James?
Just a quick point. Obviously, construction, that industry makes up a huge portion of GDP. So perhaps the current situation does present the government with an opportunity to try and increase supply, albeit with construction, there is always that 2 to 3 year lag in terms of delivery. But perhaps, like I said, presents an opportunity for increased supply across the housing market.
I think it's so basic and so obvious. Like, I was coming into the office this morning and my cabbie turns around and said, yeah, construction everywhere. That's the one thing that hasn't stopped. And it's so clear and so abundant wherever you're going. Construction has kept going and it needs to keep going. It's such an important fundamental and driver of the economy and the industry. And as long as the government supports that, and as long as private money and public money goes into that, it is a key foundation. So I agree with you there. Brilliant. Thank you everyone for joining this week. Hope you enjoyed the insight into the data we brought you. It's just so pertinent 1 year on, the numbers that are coming through now, that we're reaching a record high in the price house earnings ratio. Is a key indicator for me. Stay with us every week. We're going to give you all the data, all the intel. We're going to tell you what's going on the ground in commercial, residential, and all aspects of property, lending, finance, sales, credit, risk, and so on. So keep reaching out, keep asking the questions, keep sharing with us your needs and your requirements, and we will keep feeding that to you every week, 1 p.m. #AskRobCo every Wednesday. James, thanks again, always brilliant information, great updates. Everyone, take care, stay safe, be well, and we'll see you next week.
Thanks very much, everyone.